Sounds like we're ready to start. Good afternoon, everyone. For this panel, we're here to talk about the exit and strategies for exiting in 2021. I think wherever you look in the private markets right now, there's just a fervor in the markets, which is hard to avoid. And for me, when I was thinking about preparing for this panel discussion, it actually brought me back to the 1980s movie Spaceballs, in the scene where the colonel calls for prepare the ship for light speed. And Rick Moranis' Dark Helmet character says, no, light speed is too slow. We've got to go right to ludicrous speed. It seems like the markets are sort of in ludicrous mode now. So before we go to ludicrous speed with the panel, if we do intros, I'll start and then pass it over to Shoshana, Laura, and then Craig. Our firm, Tuckerman Capital in Hanover, New Hampshire, small market buyout strategy, has been about 20 years here, trying to build enduring value in small companies, typically in partnership with executive partners and independent. We're currently investing. Shoshana, do you want to give an intro? And then Laura and Craig, and we can jump into the conversation.
Yeah, no, I'm happy to. Thank you, Nick, for the introduction. It's nice to meet everybody. My name is Shoshana Vernick. I run a firm in Chicago called Avathon Capital, and we are invested wholly in the education and workforce management market. We think of ourselves as more stage agnostic and capital structure agnostic, meaning we get involved typically in businesses that are in Series C or greater growth stage, and then it can make either minority investments or control investments in organizations that are solving really worthy problems in that sector that we pay close attention to. We take a very research-driven approach, try to find markets that we think we'd love to own businesses in, and shepherd themselves to be very strategically relevant and find great homes for those organizations at the end of our lifetime. As Nick was saying, it's an incredibly active market, so really excited to talk to everybody about what we're seeing and hearing on the exit side.
Hi, everybody. My name is Laura Boyd. I am the head of M&A and corporate development at Norwest Venture Partners. I'm based in Palo Alto, and we're pretty broad in our investment thesis. We invest across almost all asset classes, writing checks of $100,000 on the seed side up to about $150 million. We do minority investing as well as buyouts. And on the exit side, we do about 8 to 12 transactions a year out of our 170 active investments. So pretty heavy M&A volume, decent IPO volume, about 1 to 2 of those a year, and ludicrous speed, as Nick said, on the SPAC volume. I don't want one. So excited to be here today.
Hello, everybody. Thanks for having me today. My name is Craig Foose. I'm an EVP at Sarant Capital, and I head up our growth team. I'll introduce Sarant rather briefly and then touch a bit on my background. So Sarant is a lower middle market firm that invests in vertically focused bootstrap technology and software businesses that have somewhere between $5 and $100 million of ARR, so pretty broad range, but definitely on the lower end. Our operating model centers on business building, specifically creating value through our hands-on growth team, who work with companies to execute on value creation plans and growth-oriented initiatives ranging from sales to marketing to org building. And importantly, the growth team is involved throughout the entire life cycle of a deal, starting with diligence and then going through to exit. Given the topic, it's probably worth sharing some of the relevant exits in the portfolio. So these include a number to strategics, Co-Construct to Buildertrend, Real Green to WorkWave, DocuTech to First American Financial, and then Compete to Restaurant 365. A bit of my career, I started off in the military. I was in the Coast Guard for a number of years, leading innovation for the organization. And then since I've been in a number of consulting operating roles. I've been with Sarant for nearly 4 years. And then one last point is about a year ago, I was the acting CEO of one of our portfolio companies called Compete, which, as I mentioned briefly before, recently exited to Restaurant 365. So really look forward to the discussion.
Awesome. Thanks for the intros, everyone. I think all of us have been involved with a number of exits in the recent market. I know at Tuckerman, we've had several exits, and we're a fairly concentrated strategy, but I think 3 exits in the last few years, each of which I was very eager to get out of before the market turned. And I think I've successfully predicted 6 or 8 of the last 0 peaks of the market. But we're still not here. Just going to the panel in terms of starting broad, maybe I'll start with you, Shoshana. What are some of your observations of the current exit environment? Like, how's this different than where we've been in the past?
Yeah, I mean, I think the activity is palpable. So I have been in the private equity space for 20 years, and I can't remember a time with this much sort of robust activity. I think you can sort of read as the first half of the year statistics are all coming out now. We're setting new annual records as we speak. I mean, in those M&A completion numbers are SPACs, as Laura was talking about. So, you think about it as a traditional form of new issuance, but really because of the construct of it, it is being picked up in the M&A statistics. But just the amount of capital and the low cost of capital that's out there is really making it a very, very compelling environment for high quality businesses to trade at very premium prices. I think some of the things that also make this environment a bit unusual is that we're seeing people underwriting to shorter holds on the back end, trying to also take advantage of either the SPAC market or another premium opportunity. So when I think about we have 4 in our portfolio, which is today a portfolio of 9. We've had 3 completed exits in the last 7 months, and we have 1 under letter of intent. All 3 of them were either started by strategic interest or ended with strategic interest. And in many of those instances, it's a game of 1 + 1 = many. And it's not summative to a strategic buyer right now, especially those that are in the private market who are also looking to bolt on ahead of their sale, because now the premium, both on a arbitrage basis and then on an accretion basis, is so compelling. So all of those things are feeding into, I think, the palpableness that we're seeing now on the exit side.
The observation around the potential for shorter duration hold is an interesting one. It's sort of like the music is playing and it started playing louder. Do you feel like in that observation that there's an expectation that the music is going to stop, or that it's like, there's so much capital now coming into private markets and all levels that there's some time to keep dancing?
Yeah. I'll start and then I'll let my colleagues continue. I've called it wrong for the last couple of years. I thought as we were entering the 9th year of the expansion, when was the music going to stop? And then it was the 10th year of the expansion. When is the music going to stop? And then we had a global pandemic, which really shut down the economy in a very, very rapid period of time. And in a way, it's easier to shut down an economy than turn one back on. Those are things that are not tested. And yet here we are in many sectors seeing what I would describe as a K, just a tremendous amount of rebound on high quality technology oriented areas. If you're part of that upper K, you're feeling growth, you're feeling innovation, you're feeling optimism, and that is leading to, again, very, very robust transactions. I don't see that slowing down. I think we've had a reset, but I think we're also going to feel a bit of a roar, a bit of a continuation of a boom in an expansionary environment. There's a lot of capital and a lot of kind of pent up demand. If you're on that bottom side of the K, right, the slippery side where there's more structural changes in the economy as opposed to cyclical changes in the economy, then I actually think we're going to see sort of some flat spots, and there's going to be a number of businesses that are going to be fighting kind of the negative trends of ongoing sort of a virus in the economy for a long period of time, and some definite challenges on the structural side. And there's less M&A activity happening in those particular sort of industries and subsectors.
Great. Laura, how about you all? What's the for your observations in terms of the environment in your shop?
Yeah. I think we're seeing, I really echo what Shoshana said, about continued expansion. I think the big focus for us is we invest across healthcare, technology, and consumer products. And so it's really a question of, I think we feel pretty bullish on the market, but it's about where the expansion takes place. And as she was mentioning, I think there's structural changes taking place, particularly on the tech side, as workforces move to working remotely, increasingly as I think the economy has changed in a lot of really interesting ways. We're trying to look for ways to capitalize on our exits to strategics on the tech side to support that. So it's not so much a question of when the music stops for all of us. I think it's trying to find pockets where the music is possibly louder and where you can really command those strategic multiples. And then on the other side of it is we found that strategics have been driving most of our processes, similar to Shoshana's experience. But we've also found that financial buyers have been aggressive. And I think the financial backed strategic is a really interesting animal that has emerged in some of our processes and really driven premium valuations as well. So that's been a trend that we've seen and are grateful for.
Yeah, in the small market, the small buyout market, for us is sort of 3 to 10 or 15 of EBITDA. Historically, you'd always think the strategic buyer is the outlier, and that's not the case. Net today, financials next tier up, investors, very well capitalized and very competitive, and the strategics are going to catch up in some of the running to get there. I think the financially backed strategic platform, one of our one also that's where you underwrite the strategic deal and like your the deep pocket. Laura, something that you sort of touched on was strategic as a buyer, this topic of strategic as a buyer versus financial buyers. Has your thinking in your firms changed at all in terms of how to think about buyer pools or how to stuff or prepare for certain buyers? Is there more deliberate preparation there relative to sort of where to really optimize value, or is it just the process has changed at all? How do you guys think about that when you're thinking about potential buyer?
Yeah, so we do think about it very differently. With strategic buyers, we try to plug in strategics very early into our companies. As I mentioned, we invest on the venture side all the way through growth and buyout. So it's a slightly different perspective. And when you have venture-backed companies that kind of grow into what look like more growthy companies, you have a lot more time to spend with them, ostensibly because they're going through a different life cycle change. And so we spend a lot of time plugging strategics in as early as possible. If we think a company is going to command a decent multiple, we want to have the strategic involved as early as possible. I have the conversation a lot, which is, a company will come in and say, I really think Google should buy us. And I always say, well, does Google know you? Have they heard of you? Do you talk to them? Are they a customer? And so we do that exercise a lot. And so those dialogues need to have duration. Not in every case, but generally, if you're going to hope for that inbound LOI, some good duration to build a business case internally with that strategic. On the financial side, we usually bring them in. Ideally, when you set up a healthy M&A process, it starts with a strategic bidder, and then you bring in financial bidders who help complete the competitive process. And more and more, we're seeing financials being very aggressive and in some cases leading the process, in which case, generally, you don't have to have the duration in the conversation, but you have to have all of your metrics ready. You have to have your quality of earnings, all of the different things that you do to prepare for M&A adequately. So it's generally a timing issue, but it doesn't have to be, I guess is a short answer.
What about, and hopefully you all can hear me. I think I have some microphone issues. What about the use of sell-side intermediary advisors? As you're thinking around how you use or engaging for all panelists in how you engage advisors for exit process changed at all? Laura, I'll stick with you, and then we can check in with Greg and Shoshana on this question also.
To a certain extent, it's Shoshana was mentioning how crazy it is in the market. I think we all feel that. It's difficult to get the attention that you want from advisors. So In terms of hiring bankers for our sell sides, generally we have to be aggressive. I think we've all seen that fees have come up. So when you engage with a crowded market, you have to be ready for dealing with the fallout from that. So we've definitely seen that that's been part of this new dynamic. And then in terms of secondary advisors or kind of vendors that help us get through the M&A process, it's a lot of the same. It's been very crowded, and I think engaging early has been kind of our weapon to combat that. So getting institutional buy-in, and then hoping that will carry us through and get the commitment that we need to see the transaction to completion.
It's interesting to me how in such a busy market, intermediaries are busy, and so it can be hard even to get them to even for an interesting mandate to get their attention. And find the fit. Another topic that I want to make sure we have time to cover on this panel is sort of tactical work of what we're doing with portfolio companies to prepare them for these exits. Like, when does that start? How does that different in this market? Sort of what are best there? Craig, maybe you could start the discussion around how you guys think about that work in your shop.
Yeah, absolutely, Nick. Happy to jump in here. So I think broadly speaking, there are two phases. The first phase I'll call building relationships and telling the story, and the second is prep and packaging the asset for sale. So phase one for us really begins the day you close a transaction. Like the day you close a transaction, arguably even pre-transaction, you're trying to think through what ultimately is going to be the exit plan. And so from day one, we're thinking through what is the exit universe, who are the likely buyers, what are the storylines, let's discuss those with CEOs. We should be kicking off relationship buildings with likely strategics. We should be thinking through the information campaign, aligning on the process and going through the rhythm. After that, there's ongoing, active, and continuous tracking of the industry, understanding deal trajectory, and really thinking through the internal and external catalysts that may change exit timing. So that's ongoing. But then we have really thoughtful set processes. For us, it's biannual reviews in which we're taking that information and thinking through what impact does that ultimately have on the business? How is it changing the exit timeline? How is it changing the exit story? How is it updating the buyer universe? And then ultimately, how does that feed into the broader marketing plan? So that's happening on an ongoing basis. If done right, and you're cultivating the relationships with the strategics, in many cases, you don't necessarily get to phase two, which is prepping and packaging of the asset for sale, because you get an inbound interest, which then is a process, usually engagement with a banker, and then much of the process that both Laura and Shoshana was talking about. But should it be the case that we do get to a phase two in one of our processes, we decided it's time to kick off a process, we'll then be thoughtful about, what are the set of things, both from a transaction preparation as well as an operational preparation perspective that we should be executing on with management teams.
Craig, something you said that I want to follow up on relates to creating the relationship with potential buyers well before thinking about a process. Can you speak a little bit about how that, what you guys do in terms of forming those relationships? Do your markets narrow enough that you may already have those, or is there a proactive process where you sort of say, hey, I want to be on the radar screen of X, Y, or Z strategic. Let's reach out and tell them what we're doing and let them know that we may be in the market in a year or two.
Yeah, it's thoughtful and strategic. I mean, when we close a transaction at the onset, the companies have likely just gone through a process in which they know who else is interested in them. And so what we try to do is then build upon those relationships, recognizing that there is natural fit, particularly for the top few. But other than that, we tend to broaden the aperture and really think through who are the most likely strategic buyers. We get really thoughtful around what are the key initiatives that we should be stimulating in order to get on their radar. How do we start to think through an action plan? Who are the contacts? What are the roles? What are the relationships? And what's the plan to foster it? And we do that across the top, let's call it 3 to 5 potential buyers that may exist for the particular asset. So it's very purposeful, it's very strategic, and we try to be very thoughtful about it.
Got it. I'd love to circle back with Shoshana and Laura on this topic of what you're doing tactically. If there's anything in addition to some of what Craig's practices are that you might want to share. But hey, here's how our thinking has evolved, how we want to be working with our companies with an eye towards that. I mean, everything we do is always with an eye towards exit, but specifically in thinking about preparing future sale process. Shoshana, is there anything that interesting in terms of how, or an example from your, a recent sale that might be preparing?
I mean, there's probably a couple things maybe. So one, just to kind of layer on to what Craig says, I think you would find, and we came across this when we were preparing for the panel, is there's a philosophical, I guess, agreement that from the moment you own an organization, having clarity of why that organization exists, what the vision is, how they fit in a competitive landscape, where their competitive landscape crosses into other ecosystems, and being a real student, listening to that market feedback, how they view your organization, and do you have enough people, CEO driven or otherwise, that are out there sort of sharing that story and sharing that narrative. That is both great business and great exit planning, right? And so I think we all are nodding our heads that is one of the best practices that as a private equity investor, we bring to organizations that may have otherwise been founder run or have had their head down, right? And we can bring them out of that head down posture and bring them up and out and thinking ahead of the game. And then I think the other sort of general philosophy is this is chess, right? And so when it comes to thinking through an exit, it's really understanding the psyche of the buyers, of the prospective buyers. And there isn't just one size fit all from a conversation standpoint or from a prep standpoint, but we really sort of work with management, we work with the investment bank to say, the buyer that we're about to have a meeting with, where are they in their context? What have they already told us for why they may be interested for this business? And how do we help them articulate their investment thesis and then model out what this combination can mean? And so we're sort of an active player behind the scenes in making sure that some of that joint value creation is out there. Not so much that we can negotiate how do we get our share of it, but really so we can ensure that we understand why they're buying the business in the first place. Is this the right group to go exclusive with? Do we believe they can get there? And do we believe that there's enough juice for them when they think about their ownership period, so that we can get confident that once we start this is something that we're going to be able to kind of complete? As we sort of said, there's, especially in, call it the virtual world, it's really easy for buyers to join a virtual management. So you get a lot of window shoppers, right? But working your way through that to figure out who's the organization that has edge, conviction, whatever you want to call it, but there's a sponsor there when they have to go into their investment committee or their, executive committee. You believe that they can deliver on everything that they've told you. And so selecting these parties and being involved in that game of chess, I have found to be even more kind of critical in this latest environment than potentially it might have been in the past.
Interesting. Something that you mentioned that I think is an observation for me, you talked about going exclusive in a sale process. And a couple of years ago, we ran a process. It was certainly a first for us. We didn't need to grant exclusivity. We ran multiple parties to the finish line. And I was like, this is very novel for me in our small market. I think it's more common in the more competitive middle and upper, higher tiers of the market. Have you seen the processes fundamentally shift? Like, that was a change for us. And as a buyer, I'll tell you, we would never do that. And we tend to not buy in processes anyway. But as a seller now, can we do this every time where we just have 3 parties that are running to the finish line? I'd just love to hear about your experiences and if that's changing and if that is a persistent trend, you think, or just a moment at time markets.
I mean, I'll give you our recent experience, and Laura has so many reps. It'd be interesting to hear her experience. all of the above ends up being the answer, and it's very context specific. So we help sell a very high quality asset to a strategic buyer earlier this year, and we were able to run to the finish line without exclusivity. That I find that happens, but it's certainly not the norm. You certainly want to feel like there's always competitive tension. So even if a strategic comes to you, the more prepared you are, the more you run Craig's playbook, the more prepared you are, with then the ability to launch externally to a broader group, right? You can maintain some competitive tension. The minute you sign a letter of exclusivity, you lose that leverage. And so everybody is playing that dance. As a seller, to your point, Nick, we want to hold leverage as long as we can, and we want to delay exclusivity. We want people to show that they've done work. We want people to show they've spent money. We want to understand what approvals are still required, right? We're all playing this dance till that moment with which we have to. And there, we sold a lot of businesses without meeting anybody in person, or bought businesses this year without meeting anybody in person. Like, who would have thunk, right? But we've done it. But you're looking for those signals that say, I've waived a financing contingency, or my investment committee has already signed off on this, or I can get this done in 30 days because I've already completed this list of things, and this is all I have left to do, right? So we're all playing this at the art of the deal-making game to get to that place where it's a mutual level of trust that once we head down this path, we're going to complete.
Great comments. So if there's any questions from folks in the audience side, we're looking for in the chat feed here, and we'll keep our eyes on that. I think one area that we haven't talked too much about yet is the SPAC sort of context now, and sort of how changing things for certain types of businesses. Laura, it sounds like, again, you didn't want to quantify how many, but it sounds like you guys are getting some reps in SPAC world. How has that changed recently? Is the edge taken off of that in sort of more recent periods, or are we still running there? And what are the few? We have a couple minutes left, but what are the few things just to more SPAC play for the audience to hear about?
Yeah, well, there's a lot to say about SPACs, and I think we've all heard a lot. So in the interest of time and also just interest, I'll keep it brief. But yes, we've seen a lot of inbound activity on the SPAC land, and it's been, it's great. I think anything that provides optionality is always beneficial to any exit planning. I think the most challenging aspects of it, at least from my perspective, are regulatory. I think we've seen that there's been issues with what different things that auditors want to see, the SEC wants to see. It's often quoted as sort of the Wild West. And I think what we really encourage our companies to do is, if you can go out and be a public company the traditional way, patience is usually rewarded, because we don't really know what's going to happen from a regulatory perspective long-term with SPACs. That said, I think there's a lot of companies that are well-served going out that way. It just depends on what their specific challenges and benefits and everything that they're looking at are. But the regulatory environment has made it a little bit scary from my perspective as a relatively conservative person.
How do you weigh? So you talked about comparing a SPAC to a traditional public. Just very briefly, and I don't know if there's an answer for this. How do you weigh the certainty to get there with the SPAC and those challenges versus the private sale versus the public? Do you feel like SPACs are a high credibility? This will happen when you have inbound interest, or are there real questions around that?
There's real questions. I think we've seen liquidity issues with a lot of SPACs. What happened, I want to say about 3 months ago, was there was a major warning kind of in the broader market that a lot of the SPACs that had announced that they had a certain amount raised, they no longer had access to that, and the PIPE market was becoming increasingly crowded. So it was just an issue of LPs releasing capital, making capital available so that you can actually, once you're out and you're actively out raising once you've been acquired by a SPAC and you're out raising the PIPE, that you can actually get it done. So I think in this one setting, we've really seen that that the traditional way IPO is a little bit more stable. It's a little bit more easy to predict.
Cool. Well, I think that's time. Thanks so much for sharing your insights, guys. It's really great to meet each of you. And good luck out there in ludicrous land. Let's all keep running.
Great.
Indeed.
Thanks so much.
Nick. Thanks, everybody.
Bye.